welcome to my channel. So in this video we are going to look at ratio analysis of financial ratios in analytical procedures. In analytical procedures, we looked at the audit procedures, and under audit procedures there was analytical procedures. So it's where we have the ratio analysis. So here we calculate for ratios. The first common ratio, let's start with the profitability ratios. Profitability ratios, the first one we have under this is gross profit. Gross profit margin, and the formula for gross profit margin is gross profit out of revenue or sales times 100. That's the formula for gross profit. So like when you are calculating for these ratios, you want to analyze and see whether there is a difference. So if there is any change in revenue, that is supposed to be discussed with the client. For example, if maybe revenue declined, like the previous year it was high and the current year it is low, you discuss the difference with the client to find out what went wrong. The decline in revenue can be maybe due to a reduction in the number of customers that the business is getting. It can be due to error while recording sales. It can be due to fraud or errors in accounting records or any of that. So that is it. Then the second profitability ratio is net profit margin. Net profit margin. And the formula for this is profit before interest and tax out of revenue or sales times 100. Yeah, so here maybe like in case revenue reduces, like in the previous year maybe it was 2M and then in the current year it is 1.5M. So you see that there is a reduction in revenue, but then the net profit margin doesn't reduce, but revenue reduced. So there may be a problem. So that problem has to be investigated. It can be due to errors and all that. But we are going to have like a practical example. I'm going to first give you the formulas. Then the third profitability ratio we have is return on capital employed. Return on capital employed, and this is calculated by getting profit before interest and tax divided by capital employed then multiply by 100. So those are the main three profitability ratios that we are going to use. Then we go to the efficiency ratios. Efficiency ratios, and the first one we have is inventory turnover period. inventory turnover period. And here the formula is inventory divided by cost of sales, then multiply by 365 days in a year. Then another ratio we have here is receivables collection period. And here the formula is trade receivables out of credit sales times 365 days. So for ratios, they always give you for 2 years. So you calculate the receivables collection period for the current year and then for the previous year, and then you investigate the difference, whether there was an increase or a decrease. Yeah, if there is an increase, you investigate. If there is a decrease, you find out why. Then the third one we have is the payables payment period. And here the formula is trade payables divided by credit purchases times 365 days. So those are the main 3 efficiency ratios that we are going to be using: inventory turnover period, receivables collection period, and then trade payables payment period. Then we shall have the liquidity ratios. Liquidity ratios, there are only 2. The first one is the current ratio, where we have current assets divided by current liabilities. Then the second one is the quick ratio, which is current assets. It's the same formula, you just subtract inventory. So current assets less inventory divided by current liabilities. Then we go to the investment ratios. Investment ratios, first we have debt ratio. Well, we have total debt out of total assets. Then secondly, we have the gearing ratio. And the formula for here, it's long-term debt divided by interest expense. Sorry, not interest expense. Shareholders' equity. Shareholders' equity plus long-term debt. That's the formula. Then the third one is interest cover. Here we multiply by 100. So interest cover, it is profit before interest and tax, divide by the interest expense. So these are the ratios that we are going to be using, but when they are setting a question, they will not tell you calculate the gearing ratio, they will tell you calculate any three ratios and use them to explain this and that. Calculate any, or they will tell you calculate the relevant ratios, or they will tell you using the relevant ratios. They will not specify. So you should be knowing the liquidity ratios, the efficiency ratios, the profitability ratios, then the investment ratios. Yeah, these are the main ones that I've given you.